If you're going to ask for a 100% cash at close, the valuation might come down. And it does happen. People do pay 100% cash at close.
I'm super excited to be here with a friend, an industry expert.
Dylan Burgess, he's the VP of Mergers and Acquisitions at C2G Advisors,
an M&A consulting firm that specializes in the vacation rental industry.
Someone that has a lot of perspectives from having seen this industry from many different angles, having seen a lot of transactions on the buyer side, on the seller side, and whether you're planning on selling or not, I believe this episode is going to be very relevant for you.
We've seen a lot of really successful transactions and some not so successful transactions. There's just a lot of prep to this business. We get to the finish line with companies and they don't have employment agreements or systems or contracts.
From all the transactions that you've seen, what is the biggest mistake that you would advise property managers to avoid? Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality, and where we aim to bring together entrepreneurs, investors, founders, leaders, operators in the vacation rental and hospitality space so they can tell us about the lessons they have learned along the way and maybe some of the mistakes they might have made as well, so we can avoid making those same mistakes on our end. Today, I'm super excited to be here with a friend, an industry expert, Dylan, who is in charge. He's the VP of Mergers and Acquisitions at C2G Advisors, an M&A consulting firm that specializes in the vacation rental industry. So whether you're looking to sell your property management company or to buy property management companies, he's the expert and C2G is the expert. He's also been the director of M&A for V-Trips. He was also in charge of M&A integrations and overall development at Vacasa. And it's someone that, again, has a lot of perspectives from having seen this industry from many different angles, having seen a lot of transactions on the buyer side, on the seller side. So I'm really, really excited to get into what it takes for your vacation rental portfolio to be worth more, to add more enterprise value, and whether you're planning on selling or not. I believe this episode is going to be very relevant for you. So thank you so much, Dylan, for taking the time. And we'd like to get started with, from all the transactions that you've seen, right? You've seen it all. What is the biggest mistake you see property managers make that you would advise, property managers to avoid?
Sure. Well, yeah, Sebastian, again, thanks for having me on. I'm a big fan of the Hospitality Edge podcast and a lot of the work that you guys have done at Angel Host as well too. I mean, it's great to see you guys successful on both fronts. So happy to be here. Thanks for giving me an opportunity and kind of passing me the mic here. I think from our perspective, what we see at C2G and what kind of both Jacoby, Olin, and I, who run a lot of the deals on the C2G side as advisors, we've been in the space for 10 years, and as you pointed out, we've seen a lot of really successful transactions and some not so successful transactions. And I think generally the arc of the conversations that we have with sellers kind of, during the process or shortly after, kind of looking back on what was successful and what was not, is there's just a lot of prep to this business. And as the company grows over time, many of these entrepreneurs have been operating for 15 plus years, right? They started a real estate company, and this will sound familiar to a lot of your audience, but started a real estate company, started renting their own home, and then started renting on behalf of others, or they started a long-term rental company and pivoted as kind of through a way to generate revenue on homes that were second homes and investment homes. But the companies change a lot over time, right? And a lot of that detail kind of gets lost over time. And so we get to the finish line with companies and they don't have employment agreements or systems or contracts. And so I think a lot of what I would advise to people kind of right out of the gates is just build the company like you're going to plan on selling it someday. And even if you don't, you're in a better position as it relates to the property management agreements and making sure that you're well covered in terms of liability and risk as it goes throughout the process, as well as, if you look at optimizing the business for a sale from a profitability perspective, from a perspective of thinking about building that enterprise value, you build a more successful machine along the way, even if you don't intend to sell it. And if you do, and you want to talk to us or other advisors in the space, you've got a big step up on others that have gone through the process and not really thought about sort of what that next step looks like. If you kind of build for the end in mind, then you're more successful along the way.
That makes sense. So start with the end in mind, prepare for an exit, even if you're not planning on exiting anytime soon, or even if you don't see a world where you would want to exit. Now, do you think there's any sort of common themes or things that come back, or things that the successful operators that have managed to have a successful exit, in their eyes, in your eyes, do you think there's anything that they all have in common? Like what are the similarities across those successful operations that got sold?
Yeah, yeah. I mean, you guys have done some acquisitions at Angel Host and have seen a lot of that as well directly, and certainly from conversations that you and I have had in the past. I mean, I think it's a very different skill set to start out managing one home, and sort of as the company grows, and of course, if the company is successful in doing something well, you're more of an ideal acquisition target for some of these large companies and buyers. I mean, ultimately, that's what they're interested in is growing revenue and growing profitability. And certainly some of the more successful operators that are in this industry are attracted to this business because it's a strong cash return business. And the companies that I think are successful, though, there's kind of a founder or CEO archetype that I think can be successful. And I would say, generally speaking, that tends to be somebody that's either really good at growth and development, or somebody that's really kind of operationally focused, somebody that's kind of working on the details with homeowners, guests, and employees, or somebody that's ultimately really good at kind of running that CEO function. And then those people are really good at identifying as they grow through those hurdles and incremental growth stages of the business. As that revenue starts to grow, they're really good at identifying sort of their own shortcomings, or where their strengths are, and kind of hiring out for those other functions of the business, whether they're a growth person and they need to put that operational person with detail in mind, or somebody that's going to help them kind of go through the next process. I think that person being involved in the business and having a more focused approach, rather than trying to be all things to all people, especially as you start going from 50 units to 100 units, you start to kind of need those other functions.
So in terms of like the common theme, or the thing that the most successful exits that you've seen have in common, you would say that it comes down to having a leader that is either good at growth or good at operations, or I think the third one was kind of like that financial CEO type. Um,
Yeah, sort of a more visionary type
Mhm.
person. Yeah, exactly. Yeah.
More visionary type. And I guess, this helps, of course, in getting the company to a certain level where it can be sold. Do you think who the founders are also plays a role in terms of shaping the exit, or is more about getting the company to the level that it is a good, acquisition target?
Yeah, I think it's more of the latter. I think the who that person is very important in terms of, going from founding or acquiring a company to ultimately kind of the other side of that coin, right? Going through the disposition or the sale of the business. Certainly, who that person is and who's running the ship will either dictate whether the company stays flat, declines, or
Yeah.
ultimately grows and becomes a really successful acquisition target. I think what that buyer looks like, when we can talk about this some too, but there's a ton of different buyers in the space, right? There's strategic buyers that may be in the same market as another company, and they need less of that person post close, right? It might be much more of kind of a contract purchase, or They're acquiring the property management agreements, maybe even the company, but they're in the same market and they've got a really strong team and maybe potentially even a stronger team, right? And so they can ingest that business and really kind of run it within the current org structure with the new team as well. Versus a financial buyer, a private equity group, venture capital, whoever it is, right? They're going to be much more reliant on the existing team and look to strike a strategic partnership with that group and kind of carry on that legacy in a way that aligns incentives and kind of gets them to grow post close together versus sort of they're more reliant on that person and kind of where they've taken the business. And so yeah, I mean, I think as you talk about sort of the general themes of the business, looking at the most successful acquisitions that we've done where purchase price and structure are maximized in terms of deals is the business growing in terms of profitability, revenue, and unit count, and having those consistent metrics, minimizing churn, minimizing employee churn and owner churn kind of together. Like that's it, right? And of course, there's a lot of secret sauce and a lot of rubber that meets the road to be able to maximize those things. But I think ultimately that kind of comes down to the skill set of the ownership group and the team they put around them.
Got it. So I would like to I guess break down the conversation into you know the buyer side of it and the seller side of it. So I guess let's continue on the seller side for a second. So property management companies that want to maximize their enterprise value, right?
Yeah.
There's a few things you mentioned right there. You mentioned growth, profit growth, churn, all of those things. If you had to rank the things that need to be in place in order of importance of how much they directly correlate with enterprise value, what would you put at the very top of the list of this is the one thing that you need to have figured out and spend a lot of time working on as a property management company to maximize your enterprise value?
Absolutely. Yeah, I mean, look, there's no secret here. It's profitability, and any business at the end of the day is in business to make money, and of course, do good along the way. Optimize relationships in communities, and provide for revenue partnerships for their customers as well as put food on the table for their employees for sure. But why a buyer is looking to acquire another company is for the profitability of the business, right? That's something that they're ultimately looking at. And so, looking at the margins of those business from, where revenue is trending and where expenses are trending kind of in relationship to that, and looking at kind of that EBITDA margin of, are you delivering 20 to 25% of kind of commissions and fees, net revenue, your revenue line items that the company makes? Are you delivering 20 to 25% or potentially more of that to that EBITDA, to the earnings before interest, taxes, depreciation and amortization, what we call adjusted profits when you take out like what you're paying in income tax, right? But um are you making a healthy margin, right? Delivering profitability back to the business, and that's what's ultimately going to allow you to kind of continue to reinvest in growth in the business, whether that's through acquiring your own companies, right? Or investing in organic growth, or investing in a team and in infrastructure, linen facility, cleaning supplies, whatever it is in terms of strategic expenses that come out in along the way.
When you think of a seller that's in the growth stage of their journey as an operation, and they're wanting to grow, um what would you advise in terms of like should they be comfortable sacrificing profitability a little bit to invest more on growth earlier on, or because profit is so important, you want to show profit, every year, it's okay, it's better to grow more slowly to make sure that you have a profit every single year on your books? Like what do you think is the right approach? Grow more aggressively at the sacrifice of your profit earlier on, or grow more conservatively, but make sure that there's always a profit left at the end of every year?
Yeah, it's a great question. It's a fundamental question, and I think it comes down to time horizon in terms of what and this is part kind of going back to to how we opened the conversation of, what is your exit? What is your timeline involved, right? It's no different than you and I looking at our own personal financials and looking at equities versus, on the other side, looking at a less risky bond investment, right? If I'm going to retire in 30 years or 40 years versus 5 years, I might make a different financial decision, right? And so, um, and look, these are kind of what we call main street businesses. These are businesses that are small mid market companies, generally in the vacation rental world, not Wall Street companies. But Wall Street companies make this same decision, right? They look at these strategic investments and might get valued on a pre-profitability basis because that growth engine then ultimately leads to something that's successful down the road. And so I think it comes down to, look, are you gonna sell your business in the next 2 years? If so, you might not enter into a new market. You might not go acquire a company because it is cash intensive, and you're gonna pay for that growth even just from onboarding new properties and building out a team. There's an investment level that happens to do that. Now that payoff might be huge. It might be great to even, 2 years, 3 years, 4 years down the road, right? But if ultimately you're going to look at a strategic exit in the next year, that's probably the time period that is the time period that's most important when a buyer is looking at your financials, looking at your balance sheet, looking at your income statement, and trying to come to a decision on what is the value of this business. They're going to look at that last 12 months and potentially even the last 24 months. And that's the period where I think looking to kind of optimize those financials and make decisions that are more in the now than in the future. Like that will be valued more in terms of the valuation of the business. If you've got 5 years to run the business and you're looking at a return, then you might make that a decision. And there's certainly no reason not to make that investment if you have the time for it to pay off.
That's very interesting because like if you're a property management company that's wanting to sell fast, like you want to sell in the next year or two,
Mhm.
a reflex could be let's go all in, in growth expenses, so that we are as big as possible when time comes, for the exit. But what you're saying is actually by doing that, because the buyer is going to be looking at your last 12 months, your last 24 months, you might actually be hurting that, profitability in the short term. Now, is that something that buyers sort of take out of the equation as part of their adjusted EBITDA calculation because it's growth related expenses? They don't consider it in sort of their calculation of how much to consider as I guess adjusted EBITDA for the purposes of applying a multiple on it, or regardless of whether it's growth or not, it's going to be seen as an expense that's going to hurt your EBITDA, and it's going to hurt your sort of valuation at the end of the day.
Yeah, I mean, I think fundamentally, as I look at sort of what some of the things that we did at V-Trips, and at Ficasa, I think generally speaking, a buyer is not gonna make adjustments in their EBITDA decision in terms of like, "Hey, you invested in growth." Now, certainly there are cases to be made for non-recurring or one-off expenses, like investing in a new website that happened, 2 months prior to close, right? A buyer might say, "Hey, this website's not something that's gonna recur on an annual basis." And so there will be some adjustments that happen in those, in the financials. But I would say in general, yeah, the buyer is going to look at the investment in growth, whether that's an acquisition or whether that is, opening up a new organic, office and opening up a storefront in another location to grow organically. Like those are gonna hit the P&L, and that's why I think it's hyper important. Now, a a buyer's willingness to pay might be higher, right? In the event that, I mean, that is the challenge, of course, with all of the vacation rental industry is like, are our industry is very subject to change, right? In terms of there's not a lot of stagnant companies that have, year over year it's the same in terms of profitability, revenue, or number of units that stay on, right? If you look at call it a 5 to 7 year average length of homeowner retention, right? In terms of those investments in short-term vacation rentals, like you've got to replace homes and you have homes that drop off organically. That's part of the natural churn process that happens. And so oftentimes you have a business that's growing really quickly or potentially declining, and there's just not a lot of companies that kind of sit in that middle environment. And so that's where some buyers will increase the multiple of what they're willing to pay, or they'll have some type of structure that aligns incentives to continue that growth post close. And so they might say, "Hey, Sebastian, you've got a company that's doubling year over year. Like whatever you're doing, we want to acquire your business and we want you to keep doing that." And so, maybe we'll give you some type of upside on profitability or number of units on post closing for a period of time. But they're not going to pay on an adjusted EBITDA based on kind of the investment of that growth or pro forma probably. I mean, of course we see all kinds of different deal structures, but I would say in general there may be some kind of post-close aligned incentives to keep you incentivized to do that, but it's probably not gonna be part of the closing purchase price, if that makes sense.
Now, if you are a company that has a decent critical mass of properties, but you haven't listened to Dylan yet on the importance of taking care of your profitability earlier on. So you're not profitable, but you have a lot of properties. Do you is there a different sort of valuation method that happens in those cases? If so, what is that different method, or is it just not even worth it to go out there and try to sell if your operation's not profitable? Just go make it profitable and then go to the market.
Yeah, it's always easier said than done, right? I mean, I think you hit the nail on the head in terms of profitability is great, but there's a time to be able to you look at Uber, or you look at some of these companies, right, that were not profitable for a long time and have made investments in that way to then be able to have the Amazon complex and turn that scale into profitability. And so of course, like I would say somewhere in the nature of 75% of companies in this industry are valued on a multiple of EBITDA or a multiple of profits, but there are companies that are not profitable under the current ownership structure for whatever reason. Maybe because they're small, maybe because they're growing and they continue to reinvest in the strategic development of the business. And so on a per property basis, maybe they are profitable, right? You look at Vacasa, right? 40,000 units, they weren't profitable, but on a per home basis, they are profitable, right? And so you look at those types of businesses, and yeah, there's no question that call it a quarter of the valuations we look at a multiple on a per property basis, and typically that's a multiple of revenue. Generally speaking, most companies in the industry are going to look at it based on a multiple of annual commissions. So kind of generally speaking, 1.25 to 1.75, having a multiple on that annual commission rate, because fee structures can look so differently between the seller and the buyer. So generally there's kind of a multiple of commission approach that gets used. And we C2G, we do, our team, and we do anywhere from 25 to 50 valuations a year, and we look at kind of both of those methodologies in parallel. And generally speaking, a lot of times, the middle market companies, call it a 50 to 100 unit business, like those tend to be pretty close, generally speaking. And as a company starts to get larger, the multiple of EBITDA starts to get larger, and therefore the value of the business makes sense in that regard. Versus as a company gets smaller, and a multiple of four times on 50,000 in EBITDA is just it's a small valuation, right? And so maybe the multiple on a per unit valuation might actually be higher, and the business that's buying that business, like they're not going to need two offices, right? So there's some instant synergy costs that factor heavily into a 20 unit business, right? Where that call it call it 25,000 a year in office costs. Like that's a rounding error for a company of a larger size, right? And so that's where you can look at a on a profit per unit contribution profit or contribution margin is helpful to think about in terms of how those businesses get valued either by the contracts, which is to say that probably the most valuable asset is that property management agreements, that relationship with the homeowner, or based on a multiple of EBITDA.
hmm Now you've reviewed a lot of P&Ls. You do so now with C2G, and you mentioned as well that during your time at Casa, there were 52 companies in 2019 that were bought, which is crazy. As a volume, what are the sort of the biggest mistakes that you see people make with regards to how they handle their expenses, that leads them to not be profitable? Because at the end of the day, you said that profit is the number one thing that is what matters the most to increase enterprise value. So what are people doing wrong most often that leads them to not being profitable?
Yeah. Yeah, I think it was 51 companies. So, but still a crazy 2019 in particular, and that was an interesting time, sort of right before the pandemic. But yeah, I think you can look at sort of the margin, and we do this as part of our valuations. We look at KPIs, so we look at key performance indicators across the business, and we stack up the company that we're evaluating kind of versus the general. As you mentioned, we look at a lot of financials with different companies in the industry, and we've kind of aggregated those meaningful metrics to be able to say, what is the right sort of spend here as it relates to a percentage of revenue, and I think that's a helpful way to think about it for us as we look at valuing businesses. And so for us, I think it's generally helpful to start at the top, right? The biggest line item expense for almost all of these businesses is going to be staffing. And so, generally kind of thinking about, again, we talked about companies that grow and contract. And so as you think about that business and sort of how do you align your expense model to your revenue model, as your revenue model starts to change, so too does the kind of the need for adjustments either up or down in terms of your payroll expenses or your 1099 contractor expenses, right? And so typically what we would see is somewhere in the nature of, call it a 20 to 25% payroll margin. And that's I think really really helpful, right? Like if you're above that, why are you above that, right? It may make a ton of sense. You might say, like, look, we had to go get into this other market because we wanted to diversify, either because of storms or regulations, or there's a lot of reasons why you might look to invest, as we were talking about earlier, in a new operation or a laundry facility, right? We want to buy a linen facility. It's going to improve our cost margin over time of what we're paying outside vendors. But of course, there's capital expenditures that happen on the front end to be able to do that, right? And so, when you look at hiring up and staffing, trying to kind of target where you are relative to your peers, you might be less than that as well. And that might be a good thing from a profitability perspective, but you might be burning out employees or potentially not investing in those relationships with homeowners or guests and doing inspections and things that ultimately lead to the business being successful in the long run too, right? And so, I think looking at all those margins, looking at your software cost relative to revenue, looking at um, your churn rate in terms of properties on an annual basis is, how are you guys growing on a net basis or shrinking on a net basis, and what are you
Mhm.
spending on marketing and sales, right? So there's all kinds of sort of, as the business changes over time, I think looking at sort of where you are in spend for key investments in the business, personnel, growth, marketing, technology to automate the business. Like, what are you spending as it relates to revenue? I think is a really important part of the business, and why we preach so much about understanding the financials of your business, because I think it tells a story in terms of where you're at today, but also, tells a story to a potential buyer longer term in terms of, where there is opportunity, or where the company is doing a great job.
So yeah, so understand those benchmarks which you guys have put in place. 20 to 25% payroll margin. Basically, that says don't have your payroll expenses represent more than 25% of revenue. Basically, if it is more than 25% of revenue, I guess you could look into seasonal, like converting some of the staff members into seasonal sort of workers, kind of like you were saying, to try to match your expenses to your revenue. That's kind of
Sure.
one approach. Any other sort of approaches or ideas or things, if someone's looking into this and it's like, oh shoot, I'm spending more, I'm spending a lot more that I should be spending on stuff other than seasonal contracts. Are there any other ways to kind of work around this?
Yeah. No, it's a great question, and I think there's, we can be really focused as operators. I think I've told you this, but I own a little brewery here in Portland, and I think about the expense side of the house a lot. I think the other sort of, you flip the coin over, which is potentially, a harder problem to solve, but kind of more of a fun problem to solve, is like growing the revenue to be able to match, your expense model too, right? Like, it's not, you don't just have to optimize to the nth degree on creating streamlines and synergies on the expense side. I mean, you can grow the revenue too, right? So look at the revenue and say, hey, what are our peers doing in terms of industry standard fees from a booking perspective, and of course you have to be within the market to be successful there. I think in terms of, what are you doing on a cleaning fee, on a booking fee, damage waiver versus rent, and hey, are there other opportunities for us to grow the business internally, whether that's looking at vertical integration and saying, "Hey, can we do more of the maintenance ourselves? Can we do some of the landscaping, some of the pest control, some of the, sort of skilled labor for HVAC or for plumbing? Or can we simply just upsell more in terms of earlier check-ins, late checkouts, makes more units pet friendly?" I think there's a ton of ways to kind of optimize the revenue side of the equation as well. But yeah, I mean, certainly looking at, what your software expense is, right? If you it's there's so many cool products out there to be able to grow and automate the business, but you've got to be careful about sort of when you implement that, you've got to have enough revenue and enough scale to be able to kind of make that justified and make sense to be able to do it.
What's the benchmark for tech? I'm curious. If 20 to 25% is for payroll, what does it look like for tech?
Yeah, I think it's probably in, there's we're aggregating this, and it's changing over time, of course, all the time. But I would say, generally speaking, it's probably 3 to 5% of revenue is kind of where I would look to be. Of course, that number, as in the same way as looking at, payroll margin, it's going to change over time too, right? That's a hard thing as you're small. Um, you might need that to be able to kind of optimize and run the business. But yeah, I think that 3 to 5% is the right number, and kind of building out your software suite and uh, your ability to make those decisions kind of based on what you can automate and what you have to solve with labor is helpful.
Mhm. On the topic of tech, there's this idea sometimes that creating tech will make your business worth more, and of course I'm curious to have your take on when that applies. And I guess that's something you start seeing more so when a property management company is larger and they start to have resources to invest in you know some of their own tools or dashboards or whatever that might be. Or if the person's curious, and especially now with sort of AI and all the things that are at our disposal, people can want to spend time on building because they think, oh well, if I own my, I've spoken with people that, believe it or not, I mean, I'm sure you've seen it too, that have built their own PMSs, and
Sure.
sometimes I'm like, Okay, well, how with a couple hundred properties or not even, and
Yeah.
it's like, oh, okay, that's interesting. Like, what's the mindset? And the mindset is, well, I wanna own my business. I wanna be worth more, type of thing. When does that hold true? When is it true that building proprietary technology increases enterprise value, and when is it more of a distraction and just you not spending time where you should be spending it?
Yeah. I think the simple answer is does it lead to profitability, right? And if you're using, again, if I think if you're using that same methodology to make that decision early in your business, again, if you want to keep running it and you want to build a PMS because it creates a defensible space, either because there's an amazing strategic technological advancement there that retains those homes better, or optimizes revenue because it can upsell somebody on the reservation on the guest side, right? There's a ton of cool opportunity and things that, PMS companies change every day, and if you're the one to be able to kind of lead in those changes, sure, there's a strategic advantage there. But I think doing it because it leads to more profitability is the right decision to do it, and retaining homeowners and employees and guests will lead to more profitability if you're not having to, if you're not losing people or churning, but you're adding to the top and keeping those existing relationships. Sure, I think there's strategic value. Doing something because it is something unique that adds value to the business is probably not the right way to think about adding value. Vacasa, I think, like, again, part of kind of the motivation and story there was like tech-enabled property management company, right? And I think early on there was kind of a lot of enthusiasm about that, but ultimately, if you're building a product for a customer of one, if you're building a PMS with only your property management company in mind, like, you would never build a business with one customer in mind, right? And so I think if you're building a property management software, but you intend to sell it to other property managers, like, that's its own business, and you're leveraging that stack, but it's not necessarily being built internally for the business, right? And so I think, doing things that ultimately do create scale is helpful from a profitability perspective, but thinking about long term, what is the value of that business, and then kind of secondly, like, what is core to our business, right? And if that business is a vacation rental property management company, like, what's core to that business is homeowner communication, employee communication, guest communication, cleaning homes and maintaining homes. Like, does that ultimately add value? Sure, but is it like, would your time and energy be more, lead to a stronger return if you just invested in kind of the core functions of the business first?
Mhm. I think that's a great way to put it, right? The technology in and of itself won't make your business worth more because you built it with only your needs in mind. And that in and of itself makes that technology as a standalone not valuable. But if it's helping you add profitability, then that could be, worth something.
Yeah, if it
That's
makes the technology really valuable, that's great. But if you're not selling it to somebody else, like, you're only adding an expense, not necessarily a revenue stream, right? So you got to
Mhm.
think about it kind of in that way as well.
Mhm. Now, in terms of, like, as a seller, again, like, when you're trying to one of the things, of course, you're trying to maximize for is enterprise value. You want your business to be worth as much as possible. But you also, as a seller, want to maximize, I guess, what gets paid up front, right? You want to minimize the earnout as much as possible. What are some of the things that property managers should be thinking about in terms of building their their business in a way that's going to maximize the likelihood that someone's going to be willing to pay up front for it?
Sure, sure. Yeah, I mean, selling your business is and striking a deal with a buyer is a combination of finding alignment on price and terms and structure. And so I would say that there of course, we would all want the highest price and 100% cash at close, and no seller carried financing, or no risk in terms of the buyer being able to secure those payments. But the buyer as well is going to look at making some of those decisions based on, like, what is the value of the business, and if I'm going to be asked to pay more, right? If I'm going to give a really high valuation, I might pay less at close and have a longer tail. Or um if we've got the cash and it's a small purchase, we might put some more cash at close, and we might be willing to take some more risk than if it's a really large acquisition, right? So I think there's a balance there for sure. But what I would say is there's a couple metrics that buyers are looking at in terms of their willingness to pay, and sort of how the allocation of that purchase price at closing is primarily like tied to risk, right? It's like, Sebastian, if you're selling me your business and you say, look, we've sustained this like super similar growth curve over the last 10 years versus the company's been at 5 units, and then all of a sudden in the last year it's grown to 50 units. Like, does that trend stay? What led to that, right? That's a riskier business than kind of that platform stable business. And so thinking about it, putting yourself as a seller of a business into kind of the buyer's shoes, I think it's helpful to think about what is that risk allocation, right? And some of that risk allocation might be, hey, you don't have contracted property management agreements, like you've got some or oral agreements in place, right? Like, hey, I've known Greg and Linda, and I manage their home. I've been managing their home for 5 years. But as you look to sell that property management, either as an asset, or a stock sale, like, that becomes a risk on paper to a buyer. And so thinking about that from a way of, like, how does the buyer mitigate their risk in my business? So having good um, employment agreements with my key employees that are really, like, successful in running this business, having really strong property management agreements that are kind of industry standard in terms of the terms that they might have, having a strong pacing in terms of, like, how your business is looking over time, where, like, a buyer is going to look at how are you doing this year versus same time last year, right? And so that might lead them to be more willing to take on some of that risk if the company is growing really quickly, right? Even if you lose 5 homes, like, well, you're still looking at growing 10% year over year. And so, like, hey, I might be more comfortable putting more of the capital at closing, kind of allocating that to purchase price at closing versus kind of a longer term structure. And then ultimately, I think a seller might decide, hey, the business has been growing really quickly, right? Like, maybe we've doubled year over year. And so I actually might want to take on some more post closing risk and say, hey, look, the company is really good, and certainly we'd love to be valued on a trailing 12 months, but hey, over the next year we intended to double this thing again, and, like, either give us some rollover equity in the business, and let us work together, or give us some aligned incentives post close tied to unit growth or profitability over the next period of time, and let us work together on securing those relationships. And so maybe they want a little less at close and a little more tied to kind of some upside as well, right? So I think there's a ton of ways that
Mhm.
that acquisitions get structured. But I think generally speaking, the way to maximize your purchase price at close is to have a business that's growing in terms of unit count and guest revenue, on a per unit basis, and then ultimately have a lot of structure in terms of the industry standard kind of fee stack, technology stack. You've got a team. Again, this is a good one. I think, like, if Sebastian, I'm buying your business and you're a very important part of the business, but you want to leave day one, like, okay, well, I might be less interested in taking 100% of that risk, right? Like, what does this business look like without Sebastian becomes a really interesting question. And if you've sort of started to position the business already, like pre-close, that there's a team that's going to convey and stay in place, then I might be again more willing to take on some more risk at closing.
Hmm. Yeah, no, very interesting. And how often does it happen though, like that people get acquired for full cash deals, or is that kind of almost impossible, and you should be instead trying to work on just getting the best earn out possible?
Yeah, I mean, I think you're right. Like it does come down to enterprise value in a lot of ways, right? Like if you're going to ask for 100% cash at close, the valuation might come down in terms of total potential price, right? And
Hmm.
and it does happen. I mean, there to be clear, it does happen. People do pay 100% cash at close, and typically, I think the reason that a group might come in and pay 100% cash at close is one, they're going to lower the valuation multiple and say like, we're going to take the risk on this, and instead of paying it to you, we're just going to hold back some of the purchase price, but we'll pay you cash
Hmm.
at close. Or they might say, "Look, the business is growing so quickly, like, we're gonna factor that in terms of what we think the business is going to do over time, and instead of having some kind of earn out or earn up strategy, having some kind of profit share, we might just say, look, the business is growing at 30% year over year, and so we're gonna build that into the pro forma of what we're gonna pay, and we might pay it all at close and take the risk that this business is worth another 30% or 60% in 2 years, and that's part of the investment thesis that we made, and, a way to kind of retain, happiness with that seller and keep them around and
Hmm.
bought into the program.
I love how these are all levers. You pull on one, and then the
Sure.
other one gets affected, and they're all interrelated. It's so beautiful.
Yeah.
Last thing on the seller side before moving on to the buyer. Maybe last two things on the seller side. Um, when it comes to like making, because there's risk on the buyer side, like you said, the more perceived risk the buyer sees, the less they're going to be willing to pay up front. What about the risk on the seller side to accept an earnout? How can the seller protect that future payout? Like how can the seller sort of fight for their best interests around making it so that it's not going to be just, it's going to sound like it's a great exit, but in reality it's going to be very unlikely for you to ever see that money in the future because it's up in the air.
Yeah. Yeah, I mean, I think the number one way for that seller to ensure that they're gonna get, let's say for instance, they're gonna get 70% cash at close. It's very, very common kind of range of call it 60 to 80% cash at close. I think the easiest way for the seller to impact that is to stay on over that period of time. If the earnout period is a year, then them being involved in the business and continuing to do what the business has been successful doing is the best way to maximize that, right? If the buyer is saying, "Hey, we're going to give you 30% over tied to homeowner relationships or tied to revenue retention or profitability. You delivered this much EBITDA at close, and if you keep that much EBITDA over the next 12 months, we'll give you the remaining 30% or potentially have some upside. Then you being involved in staying on and managing that is probably the best way to have an impact on that. If that's not part of your exit strategy and you want to sell the business to go fund something else, right? Then there's other mechanisms I think that you can put in place to provide some assurances. And I think that kind of the second best thing to you being involved is having a team that's going to convey and a team that you've built up to be successful in transferring with that business. The other things are really strong property management agreements, a strong pipeline and growth portfolio. So, having the ability to refer new relationships to that buyer post close is ultimately like, if you've built really strong realtor relationships or you've built really strong relationships with your homeowners and you've got a homeowner referral program that you can, refer those new property management agreements post close, like that's a huge way to ensure that the company is going to be successful post close, and therefore you're going to be able to maximize that earnout.
Hmm. Yeah. And in terms of asset uh, transactions versus share transactions, as a seller, should you be trying to optimize for one versus the other? The answer might be different as a buyer, but I'm curious to know as a seller, what
Yeah, I
what is the ideal structure?
yeah. Yeah, so, whether it's a stock sale or an asset sale kind of depends upon what you've done. Again, thinking about sort of building for the future and sort of how you've built the business. I think generally speaking, I mean, a seller is going to want to use a membership interest purchase or a stock sale to the degree that they can to maximize the benefit of the sale and kind of reduce their liability over time, right? If you sell the business as an asset sale, like you're still kind of retaining the liability associated with that business. And a buyer might say, look, I want to buy the business as an asset purchase agreement because there may be some legal litigation that doesn't make sense for the buyer to take on risk there, right? Or there may be some other types of liabilities, tax liabilities, employment liability, who knows? There also may be contracts, the way that um, leases are set up or property management agreements that aren't necessarily assignable, and so you can't necessarily just convey those at closing. You have to actually either get consent to be able to transfer those relationships, or you've got to use a membership interest purchase agreement or a stock sale, whether it's a corporation or a limited liability corporation. And so, yeah, I think generally speaking that, the the reason that a buyer might feel more comfortable taking on the business as a stock sale versus as an asset sale does at the end of the day come back to how again, the risk allocation there and sort of how well the company has done to draft agreements and put agreements in place to make sure that they limit their liability for their own company while they're operating, and then ultimately for the business that they're selling.
So the buyer sounds like that in most cases, the buyer would prefer an asset sale because it protects their liability, and the seller would prefer a stock, sale because it protects their liability. And what's more common? Like what do you see more often?
Yeah, I would say in general, what we see on kind of the smaller transaction size, both number of units and total purchase price, like the smaller the company is, the more likely it is to be a stock sale or an asset purchase agreement. And as
Mhm.
companies get larger, you tend to sort of see things move to a stock sale or membership interest purchase agreement. And I think at the end of the day, a lot of the reasons for that are tied to the ability for those relationships to convey. Buying something in a stock sale or membership interest purchase just requires less work of the buyer to go out and reestablish some of those relationships with employees, with homeowners, with potential vendors, right? You're assuming a lot of those agreements and a lot of that existing infrastructure and bank accounts and all kinds of kind of the post close integration work that has to happen versus, if you've got a 5 unit business, like it might not make sense to take on the risk tied to that entity. If you're just interested in the agreements and potentially the domain name and a
Mhm.
vehicle or something like that, then it's really easy to establish those new relationships, and it might actually be beneficial for those homeowners or the employees to move
Mm.
to the new entity, and therefore, um, you know, the work of reestablishing those relationships is probably more beneficial than the liability that you might take on.
Mhm. You mentioned post-merger integration. I think this is actually a great segue into the buyer side because you had mentioned that one of the things you noticed at Vacasa is that they used to do a lot of work post acquisition, um, and you would have, I guess, suggested or you would have you would have it would have been beneficial to understand the thesis a little bit more prior to buying rather than doing so much work post acquisition. So what can you tell us about that? What's like on the buyer side? Now we're switching to the buyer side. What is a thesis? Why is it so important? And how do you build it? And how does it prevent you from headaches afterwards in the
Yeah.
post acquisition integration side of things?
Yeah, so I mean, we I would say probably 80% of C2G's business at this point is representation on the seller side. So we do a lot of work on the sell side, but probably 20% of our business is on buy side. And we don't do those at the same time. We work on one side of the deal or the other usually. But generally speaking, I mean, when we're advising on the buy side, really it's being convicted in what your deal thesis is. Like, why are you buying this company, right? Are you buying it to get into a new market and grow that market? And in which case, having a really strong post acquisition business development plan is going to be really, really important. Um, or are you buying the business because you want to move up market in your own market? You might say, hey, we've got a ton of condos, 2 bedrooms, 3 bedrooms. We really want to move into the kind of 5 bedroom and larger inventory or more luxury inventory. And so this portfolio that we're buying allows us to cross sell into that type of inventory and really add to our per unit level of contribution from a profit margin perspective. And so, I think there's been a lot of M&A activity in the space over the past, call it 6 years, really. Like, there's been a lot of increased eyes, increased private equity groups, increased strategic buyers from, companies that historically have grown 100% through organic growth have decided, hey, these property management agreements are very sticky, and that sometimes, getting those people to getting homeowners to switch to another property manager is really, really hard. It's just there's there's a lot of revenue on the books pretty far out in a lot of these homes, and so it is really hard to get people to move property management agreements, and that's why that you've seen a lot of acquisition that's happened in the space. Um, but as you do that, I think being really convicted about sort of the why that you intend to do it, and then how do you execute on that thesis, right? If you've gone in and said this company is under optimized, that maybe they're on one booking channel, or they don't have a great dynamic pricing tool, or their reviews are really bad, right? And so moving them over to this other platform allows us to execute on that thesis. Well, if you don't move them onto a new brand and you just keep their same brand and their same reviews, like, obviously you're not going to execute on that thesis. Similarly, if you don't, move them over to a new pricing tool, if that was your thesis, or you don't add the booking channels like right out of the gates, you're not going to be able to kind of create and execute on that return on investment. Or similarly, if you're going to go into a new market and you don't have a plan for how you're going to grow that market post close, like, I think you're sort of shooting yourself in the foot in terms of what your investment thesis was. You might have great intentions going in, but I think being able to build that into the integration plan and kind of what that looks like from a post close perspective, I think that's ultimately what's going to prove out the success of the acquisition. Getting the acquisition done is one aspect, and integration can look very different with a ton of these buyers, right? You can buy it and leave it alone. Let the
Mhm.
same, the seller of that business, let them continue to run the business directly, and you've got, you know, you're supporting from the parent company level, but, like, the brand stays in place. And you see this with a lot of financial buyers. They're just, they're buying it and leaving it, and maybe investing in strategic growth and business development and potentially some marketing. Or there's kind of some more like middle integration approach where you're consolidating kind of some of the back end of these businesses, where you might consolidate some of the technology and software, some of the shared services, um, but you're leaving again kind of the brand in place. Or you can say, we're going to move all of that to the buyer's business, right? And there's reasons that different buyers tend to do any number of those potential integration playbooks, but But all of that requires, a tremendous amount of work post close to make sure that the key stakeholders, the employees, the homeowners, the guests, vendors in the community, vendor partners and technology groups are engaged and want to work with you post close.
Super interesting. Now, if we were to like categorize the types of reasons why someone would buy an operation, I mean, you have the kind of like the financial way of looking at it from private equity or whatnot, where it's really just like it's just an investment, right? It's just an investment vehicle. It's gotta provide a certain return on investment, and that in and of itself is the reason, like you said, because it's sticky, and all of those things why you're making the move. I guess on the other hand, if you're thinking of a property management company acquiring other property management companies, you have, people that want to be expanding more rapidly and more aggressively in their current market, and then you have people that want to open new markets. I guess, is there anything else as a category of reasons why someone would buy an operation that I might be missing?
Yeah. Yeah, I mean, I think a big one for a lot of companies is diversification. And
Mm,
these businesses, depending upon, I mean, every single market in the US around the world is different, right? And some of those markets are 4-season markets. If you're lucky, you might have a Hawaii, right? Where sure, there's a little bit of variability on a seasonality perspective, but people go there all year, right? Versus, on the other side of that coin, you've got a Cape Cod, which is like a 10, 12, maybe if we're being friendly, 14-week season, right? And so you've got a lot of different markets that look totally different. You've got some fall markets like your Vermonts, like your Gatlinburgs that have kind of a fall colors, Colorado as well. You get some leaf peepers as people say, where people go to those markets in the fall, which is traditionally like a very quiet time for beach markets and mountain markets. We often refer to it as mud season, right? Where it's like
mhm,
there's no snow, but there's also, no great hiking in the summertime, right? And so a lot of companies tend to want to diversify from a cash flow perspective, from a seasonality perspective, but also diversify from a storm risk perspective, right? You see people that you've seen a lot of buying groups that are like over indexed to Florida, and if something happens, like there's a risk factor there, right? Or they're over indexed and they're only in one market.
mhm,
They might be, you see some of this even diversifying within different communities within the same market, right? Right now we're sort of talking about a national scale and being in multiple markets. But even in the same market, I mean, pick a spot, right? But on on the Oregon coast, like if you're in one market, having homes in different communities so that if one HOA decides, hey, we're gonna ban short-term rentals, right? Like hopefully you're in a different set of inventory and a different area that allows you to be successful post close as well, both from a cash flow perspective, a regulatory perspective as well. And then yeah, I mean, I think you're spot on for thinking about, again, if you have the idea of building this business with an end in mind, right? Which some people do, right? I want to build the business. I'm going to sell it for $10 million. Well, maybe you're in a market that is a very small market, and you're just not going to be able to get to the right number of properties or the right size and scale to be able to get to that exit that you want. And so either you have to change your goal to match the market size that you're in, or you've got to go into multiple markets, or you've got to acquire other inventory to be able to move into a different type of inventory because you haven't been successful in growing there or organically, right? And so I think there can be a lot of fundamental reasons for M&A and certainly enterprise, like growing enterprise value in terms of, being able to create a more successful enterprise is one fundamental reason that you might acquire a company. I think the other one is like, a lot of these markets are really regulated and restricted markets, and we're going to see more regulation and restriction over time. And I think when it's done correctly, it's actually like lifted up performance on those units in those markets. But those contracts that are in regulated markets become really important, and so acquisition to acquire the right contracts, the right homes is also really meaningful.
Mhm. Yeah, super interesting. And on the note, you mentioned earlier that one of the things you see when it comes to the thesis, not not executing properly post acquisition on the thesis is like not having a proper post acquisition business development strategy. So let's say you're making an acquisition because you want to diversify or you're going to grow into a new market, and then you buy and then you leave it there. You don't have anything in place to grow that. Can you elaborate a little bit on that? Because I see a lot of property management companies have no business development strategy that is thorough. Sometimes processes are lacking around that area specifically. It kind of seems to be something that just happens. Business development just happens, and there's no kind of process around it. Why do you think that's important, and what can PMs do around that to prepare for a business development strategy post merger or post
Yeah.
acquisition?
Yeah, I mean, at the end of the day, success breeds success, and a lot of these vacation rental property management companies have grown year over year without necessarily, to your point, some of the best businesses in this industry. I mean, we've seen companies that are 300 units under management, and they've never done any type of marketing, right? They've been really successful. They've managed to retain their existing relationships and win new relationships because they've just done a good job, and they have scale in the market, and they've got their signs on a lot of streets, right? And at the homes that they manage, and that's kind of been their organic business development strategy. And that's all fine and good as you continue to grow, right? You could argue you might have grown faster if you had done a little bit of organic marketing and business development and had, more relationships with realtors in the market, more relationships with other property managers for inventory that may or may not fit either program, right? Um, but but I think the biggest challenge there is if I'm a buyer and I see this company that's growing at that kind of 30% year over year basis on a homeowner perspective, and I don't understand why they're growing like that, you know, it's gonna be really hard for me to recreate that strategy, and maybe surely their plan of attack and sort of what they're doing is to just continue to be successful and operate. It you may go into that investment with that in mind of like, that is gonna be our business development strategy, right? We don't actually have to do much, right? So it doesn't make sense to be spending a lot of money on a business development strategy that's already working. It's like, how do we, talk to that seller and talk like, how do we optimize this? How do we make this better? How do we grow even further? Or you might say, maybe the business does grow even faster with some of that optimization, maybe plugging in a Ventori or a company that, Sun Squared, some of these others that can do some of this marketing and optimization post close on my behalf. Like, maybe that's really successful. Maybe hiring somebody that is a business development person that can go to those realtor meetings and create, a new pipeline is going to be able to help kind of reduce some of the churn on the other side, right? And you continue to grow organically on the other side. But I think, again, it comes down to identifying what has made that business really successful and doing more of those things and saying where are there opportunities to make improvements and how do we do those things as well. And ultimately at the end of the day, quantifying, how much of that is going to make the change, right? You don't want to make the change on the small incremental changes that are going to impact the P&L first. You want to start with the low hanging fruit and where there's real economic opportunity.
Hmm. And then on the going back to that growth strategy side of things, sometimes um, you see property managers kind of debating or considering M&A as an alternative to organic marketing or paid ads or whatever that might be, direct mail. When do you think a property management company should start to consider M&A as a growth strategy versus when do you think they should just be adding owners, one at a time? Don't get distracted thinking you're gonna accelerate your growth by, buying portfolios at a time.
Yeah. Yeah, I think identifying a roadmap for a sustainable growth plan is great, right? And I think ultimately if you had 30% year over year growth and you were doing that organically, like you shouldn't go out and acquire another company, right? Unless it allows you to to run two markets that are growing at 30% now instead of one that's growing at 30%, right? But I think in general, the cost, even if you include a fully baked business development team and a marketing team, kind of lead generation team. I mean, the cost on a customer acquisition cost on the organic side is likely to be cheaper than the M&A cost. Now, the time to get from 0 to 25 new homes on the organic side is going to be longer, likely, than to acquire 25 contracts from another company. And so I think it comes down to, again, this is sort of why we started from the outset of like, what do you want to be when you grow up, right? Like what are your goals? Are you trying to get to a certain size of the business? Are you trying to optimize for, a sale in the event of an eventual exit, I think, or are you trying to, to grow and kind of be a a more stable business in your market for the long run? There's no question that growing more slowly over time is gonna be a more stable, more predictable growth curve and likely a more predictable, stable, expense program on your P&L that's easier to manage for than ingesting and integrating these 25 units. Now that might really help you. It might be inventory that is, really attractive. It might be a deal. It might be an opportunistic deal that another property manager in your market comes to you and says, "Hey, we've got a lot of respect for your business. We'd love to join hands. We'd love to partner. We'd love to sell our business." And I think that's certainly opportunity, right, in terms of being able to grow that inventory. But there is a you're gonna have to bring on a team member or team members to be able to do that. And so I think thinking again about sort of what the goals of the business are, what the goals of that specific acquisition is, and being really convicted that like, hey, if you're looking for a partner, I mean, Sebastian, if you're running a 30 unit company and you're pretty understaffed and somebody comes to you and says, "Hey, I want a partner," and they want a strategic partnership, y- you might be in a great place. You might be like, "Hey, I really actually need somebody. I need a team." And taking on these other 10 units like allows us to add revenue and build out the team. Like that might be a really strategic decision. If that person says, "I want to sell the business and be gone," now you've just gone from 30 to 40 units and you're the same team and you've actually just compounded your problem, right? So I think being really strategic about what the business needs are, whether that's new inventory, whether that's revenue to be able to go fund some of exactly what we talked about earlier, right? Like if from a margins perspective, you're really happy with your software stack, but it's eating up a large part of your profitability. Like, okay, you might have a revenue problem, and like being able to go out and add some of these revenue producing properties to the program, like allows you to optimize and kind of grow into that software spend. Like that's a super compelling argument for wanting to do an acquisition.
I love it, man. I love it. You've been so generous with your time, man. Just want to ask one last question, which is what question have I not asked that you think is super important for property managers to be thinking about, whether on the seller side or on the buyer side, that we didn't cover?
I think when is the right time to sell is a really interesting question, kind of along the same lines of this conversation, right? And there will be people listening to this podcast and other podcasts that are asking themselves, is the market hot right now? Should I sell my business right now, right? Or for that matter, to buy right now? Um, and and sort of when is that, right? And I think that's something that we get all the time. We again, we do anywhere from 25 to 50 valuations a year, and we have a lot of conversations with strategic buyers in the space, financial buyers in the space, and I think again, the when the right time to sell is for you. I think if you're going purely off of what is the market doing, I think you're thinking about it incorrectly. I think there's so many more factors other than what is the multiple of today, and thinking about it just purely on a multiple of like our company's paying a good multiple, I think is if you could do things over, if you could start from the start and kind of think about what you're setting out to accomplish, like that's not how you would go about selling your business. And so I think kind of breaking that perspective of what is the market paying in terms of a multiple of EBITDA, and kind of shifting your mind and shifting your mentality to like, what do I want to sell this business for? What am I setting out to try and build, right? And am I trying to get an exit where I'm gonna retire and sell the business? Like that's a different consideration than I'm trying to build a company with a purchase price enterprise value of 10 million. And so, whether the market's paying of a 5 multiple or a 7 multiple is irrelevant in terms of, where you are. I think what you're setting out to build, how are you getting there and achieving that multiple, and sort of what the market's going to be fairly consistent from a multiples perspective. I think as a lot of these companies are, they can be pretty flexible with price and terms and structure. And so thinking about, why do I want to sell? At what scale do I want to sell? How do I get there, and how do I find the right partner? Like, to me, that's actually like sort of much more the interesting question, and thinking about that earlier in the process versus what is the purchase price is a much more interesting way to go about thinking about how to build for the future.
I love it, Dylan. Hey, thank you so much for your time. And this was super generous and very insightful. So really, really appreciate it and look forward to seeing you soon.
Thanks for having me on, Sebastian. Appreciate it.
All right. Have a good one.
Cheers.